Hi, I'm Whitney Espich, the CEO of the MIT Alumni Association, and I hope you enjoy this digital production created for alumni and friends like you.
Welcome to MIT's Faculty Forum Online. I'm Michelle Hanlon, the Howard W. Johnson Professor of Accounting at the MIT Sloan School of Management. I will serve as a moderator today. This broadcast is sponsored in part by MIT Sloan Executive Education, the MIT Federal Credit Union, and MIT Professional Education. We're talking this hour with Bob Posen. He's a senior lecturer at the Sloan School of Management, specializing in technological innovation, entrepreneurship, and strategic management. He is also a non-resident senior fellow at the Brookings Institution. In the spring of 2021, Bob will be publishing a new book on productivity when working remotely. This book is entitled Remote Inc., How to Thrive at Work, Wherever You Are. Today's topic is COVID and your taxes. We'll start by discussing individual tax changes in 2020, then cover estate and gift taxes, and then we'll move on to a discussion of business taxes. After each topic, we'll pause for Q&A. To ask a question, use the Q&A feature on your Zoom toolbar. We'll get to as many questions as time allows. Please welcome Bob Posen. Bob?
Well, thank you for that nice introduction, Michelle. Always glad to be working with you. Michelle's a very talented professor in accounting and tax, and often helps me figure out what the real answers are to some of these complex questions. So I'm going to rely on her to correct any errors that I might have. We're going to try to do this informally. We have these slides. Let's go quickly to the first slide. As Michelle said, we're going to cover these three areas: individual income tax, estate tax, and business taxes, and we'll have a little Q&A after each one. Michelle will start off the Q&A after each one, and then we'll open it up to audience questions. Okay, let's start with individual income taxes. So here are a few highlights of changes that have occurred. In 2020, lots of people who had income of less than $150,000 wound up getting $1,200 per adult and $500 for each dependent. These are not taxable, so don't worry about being taxed on them. And then some people have asked us, well, if I had a great income in 2019, but 2020, I got laid off, so I'm under 150,000, can I still get this? And the answer is yes. You got to claim it on your 2020 tax return. If you go down below 150 in 2020, you're okay. You can get this even though the original payments are based on your 2019 income. Next slide. On the retirement side, basically there was a lot of forgiveness. If you withdrew from your 401k or similar plan before you were 59 and a half, there was a tax penalty, but now you won't have a tax penalty if anyone in your family had the coronavirus, or if you suffered adverse financial consequences. That language is written so loosely, it will apply to almost anybody. Second of all, no required minimum distribution. This applies now to people who are 72 and older from DC plans or IRAs. And if you made one, you could repay it, but you had to repay it earlier this year. Lastly, loans from qualified plans, they had a more generous provision going from 50 to 100,000, but you had to do that again earlier this year. Next slide. On student loans, you can pay off your employer can help you by paying off up to $5,250 in your student loans, and you won't recognize any taxable income. So that's really good. And I also note that if you have a federal student loan, not a private loan, if it's from the federal government, there essentially was a holiday in 2020. No loan repayment due, no interest accruals, and no collection on defaulted loans. Last slide, next slide on individual. So the last thing we want to talk about on the individual side is charitable deductions. If you don't itemize it used to be the case that you couldn't deduct charitable deductions, but you can for 2020 up to $300 in cash donations to charities. If you do itemize, there generally is a limit of 60% of your adjusted gross income in terms of your cash donations, but that was increased to 100%. So that's something you could do now between now and the end of the year. If you wanted to donate cash to charities, this is a good time to do it. But note that this new provision does not apply to stock donations. It's only cash, and it doesn't apply if you are making your contribution to a donor advised fund like the Fidelity Gift Fund. You have to make it directly to a 501c3 like MIT, which I'm sure would be glad to have your higher donation this year. So I'm going to stop there and let's see if we can generate a little discussion.
Thank you, Bob. So I'll kick it off with one question, but then if the alumni can just remember to put your questions in Q&A if you have any questions, and if you see a question that you would also like to know the answer to, just upvote that question, that would be great. So Bob, as you know, we have two big runoff elections in January in Georgia, and those runoffs will determine the balance of power in the Senate. What's your view on, what President-elect Biden will be able to do if the Democrats do not get the majority in the Senate?
Well, I think in the area of individual income taxes, not much. You could change the enforcement policies to put a lot more resources into IRS audits of higher income people. But most of the things we've talked about here could only be changed by legislation. So not much could happen there.
Okay, and what about if he does get the majority in the Senate?
Well, if Democrats get the majority either in 2021 or in 2022, Biden has a pretty broad and aggressive tax plan. I'll just mention a few things. One is he's going to apply the 6.2% in Social Security taxes to people with over 400,000. So that limit now is about 130, 140,000, 135,000. So that would be a big tax increase. He's going to raise the top rate to 400,000 for people over 400,000. If I had a guess, he'll raise the tax rate to about 40%, or he'll try. And then he's also proposing to raise the capital gains rate to roughly equate with the ordinary income rate. So that would mean a big increase from the 20 to 23% it is now to 39 or 40%. Those are all things that he will want to do if Democrats get the Senate. But I should mention that if they get the Senate by only one vote, there are some moderate or conservative Democrats still in the Senate, and they may not go along with that. So it'd be a pretty tough political fight if there's a, say, 51 to 49 majority of Democrats. So it's a little hard to say what would happen. Actually, there would have to be some compromises in order to get that sort of tax plan through. Let me stop there and, Michelle, I don't know whether you have other questions from the chat.
Yeah, there's a lot of questions coming in. They're very good. So one is an interesting one and quite appropriate for the time period that we're in, is that a lot of people are currently working at home. And so what can they do with their expenses that they're incurring at home? Can they take a home office deduction, for example, for their work from home setup?
Yeah, they can take a home office deduction. Historically, that's been a bit of a trigger for IRS audits. So people have been a little reluctant to do it, but I think there are going to be so many people who are taking deductions this year that I doubt whether that's going to be an audit trigger because there'll be so many people. Another thing is that's going to be complicated is if you're working from home, which state is going to try to tax your income? For instance, if you live in New Hampshire and you work in Boston, and for a Boston-based company, you usually were paying mainly Massachusetts state income tax, but you might think you're going to get out of it since New Hampshire doesn't have an income tax, but I'll bet you that Massachusetts is going to come looking for your income, even though you've been working from home. So that's something you ought to keep in mind.
Okay, great. The next question that has been upvoted quite a bit is, can you discuss the pros and cons of doing a conversion from a traditional IRA to a Roth IRA?
That's a complicated question. You got to get your calculator out. But it depends. Okay, but if you convert, you're going to pay a tax today, and you're going to pay a tax on ordinary income rates. If you wait, then you'll have this minimum required distribution, and you'll, over a period of time, have to distribute your monies in your IRA, and again, you'll pay at ordinary rates. So what's the advantage? Generally, people try not to pay taxes now for things that they could pay taxes later. And so that would tend to militate against converting to a Roth now. But if you believe that tax rates are going to go up, if you believe the Democrats are going to come and control the Senate and raise the top rate, so that's a reason to do it now. And a second reason to do it now is if you want to make a large charitable contribution and take advantage of this 100% AGI provision for that. Maybe you don't have enough income to do that, so you can create some more income. And then you have the advantage of a Roth, which is that from now on, whatever appreciation is in the Roth isn't going to be taxable to you. And so, it's a trade-off there. So I think the key things are what you think the rates are going to be in the future, and how much appreciation you think you would have if you convert it. If you think rates are relatively low now, that's a reason to convert. If you think you're going to get a big appreciation between now and the time you die, then those are reasons to convert. So you gotta make some, you can run a lot of numbers, but ultimately you gotta make some judgment calls about rates and appreciation.
Yeah, exactly. Thank you, Bob. I think we probably have one more time for this section, and then we have time for one more question for this section. And then if there are additional ones that we have time at the end, we can come back to them. But there's two questions that are kind of similar in spirit. One is whether the $300 charitable contribution is for a single taxpayer. Does it get doubled if it's married filing joint? And then a similar spirited question is whether the $150,000 kind of income limit before the phase out for the stimulus checks, is that married filing jointly or single?
Well, Michelle, you may know these answers better than I do. I think the 150,000 is a joint filer
That's
requirement.
married filing joint, yes.
So you need to be under 150 as a joint filer. The $300 itemized, I'm not sure of the answer. Is that per taxpayer or is that per tax return?
I think it's per tax return.
Yeah. So that's $300 total. So if you're joint filer, you wouldn't get $600. You'd still get $300. So on the other hand, if you're, the 150 is going to be judged as a couple. So, so you can't say that you make only, 90 and therefore you're okay. That doesn't work.
Right. Okay, great. These are great questions, everyone. And if we have time, we'll come back to these. But Bob, I think we're at the point in the schedule where we probably should move along to the estate and gift tax and then proceed from there.
Okay. Yeah, we can always come back and have general Q&A at the end. So let's C. So this is a relatively short set of slides. I think we only have one in this area, maybe two. But right now, there are very generous lifetime exemptions, 11.58 for a single person and 23.16 million for a joint filer. You can also, if you do it right, give unlimited set of gifts to your spouse. These are all federal rules. In addition, you can give away $15,000 per person, essentially to anyone, and you don't have to file a gift tax return. And importantly, if you have children or grandchildren, you can pay for their medical expenses or their tuition payments. I suggest strongly that you pay directly to the institution and not to your child or grandchild. So those are the main changes that those are the main rules for estate and gift tax now. So I'm going to turn it to Michelle.
Yeah, thank you, Bob. So I'll throw back the same question to you again. With the runoffs in January, what do you think could be done by President-elect Biden if he does get control of the Senate, and then if he does not, either way?
Okay, I think if Biden does not get control of the Senate, it's pretty limited what he could do. There are probably some technical regulations, but not much. On the other hand, if Democrats do get control of the Senate, he has a very broad-based and aggressive program for estate tax reform. First thing is he's going to lower that exemption. People are talking about something in the $3.5 to $5 million range, and he'll up the rate. It's now 40% to 45%. What does that mean? If you look at your assets, including your home, and think about whether you would have more than 3.5 million per person, so that's 7 million per couple, or 5 million is 10 million. So if you're going to make that sort of gift or bequest, it's probably a good time to do it, or at least consider doing it, because those exemption requirements will go up would go down pretty quickly. A second thing that's on Biden's agenda, which I think would get congressional support, is to eliminate what's called step up in basis at death. Right now, for instance, if you have a home, let's assume you bought it for $300,000 many years ago, it's now worth $3 million. On your death, you give your home to your child and they sell it immediately, they won't recognize any capital gain. That $3 million will be the new basis for the home. It won't be $300,000, it will step up to $3 million. And third of all, I think we see lots of proposals on the Democratic side for annual taxes on unrealized gains, capital gains, on wealth taxes. We have on the unrealized gains, Senator Wyden has what's called a mark-to-market proposal that would tax you on unrealized gains in publicly traded stock, and has a complicated formula for privately traded assets. And then our own Elizabeth Warren has lots of proposals on wealth taxes. So those will be harder to pass. So if I had a guess, if Democrats control the Senate, the exemptions will go way down. I'd guess around 5 million per person, 10 million per couple. And I think step up in basis would be eliminated. Whether or not we would really get a wealth tax or an unrealized gain tax, I'm not sure.
Okay, great. Thank you, Bob. So some particular questions about the estate and gift tax. I think there's a few in here that have this type of spirit. If we think that President-elect Biden might win the Senate in January, or if we just think maybe he'll get the Senate in, say, 2 years, what kind of planning should we be doing now? Should we be gifting a lot to our children or somebody, or should we donate a lot to a charity? These are the types of questions that we're seeing. What do we think? How quickly will Biden be able to put some changes in place?
Well, I think lowering the exemption amount is something that you could put in place pretty quickly. It's not a very complex piece of legislation. And I think the Democrats would vote for that. How low it would get, I don't know. But the clear message is, if you're intending to make gifts to your children or grandchildren, now's a good time to do it. And you don't want to wait for that exemption that goes down. Now, if you're below, let's say, $10 million per couple, I think you're probably going to be okay. But if you have more assets that you want to transfer to your children or grandchildren, I would seriously consider doing it now.
Yeah, if I can just add a couple things to that, Bob, do you mind? I
Yeah,
think
sure.
you're right. It's good to think about these things at this point in time because we may have a large shift. One question is, of course, I think Biden has said recently, possibly, that because we're kind of in a recession, at least some portion of the economy is in a recession, that he may not push for tax changes quickly. So you may have next year at least, but on the other hand, if they perceive the estate and gift tax to benefit primarily the wealthy, people who have endured much less of this recession, then they may push it through. So I've heard both sides, so it could go either way. But it is a good time to think about it because we know for sure what the rules are now.
Yeah. Looking into the chat, there were a few questions. One is, can I give 15,000 to my son and another 15,000 to my daughter? And the answer is, yeah, you can give 15,000 to your son. Your wife can give 15,000 to your son. You can give 15,000 to your daughter, and your wife can give 15,000 to your daughter. So that's there. Another question is, are 5 contributions to 529s, the educational account, subject to the 15,000 per year limit? And the answer is yes, they are. But there's a way in which you can give 75,000 to a 529 plan in 1 year and spread it out over 5 years. So that's a different and way to do it. But generally, 529s are there. And I think one more question, people said, what about step up in basis? Won't it be a record keeping nightmare? And the answer is, it would raise some issues about record keeping, but then you'd have to figure out what was the basis of something that you bought a long time ago. You may have made some improvements in the house, etc. So that's the sort of thing that you'd have to consider. Is there a gift tax if you give more than 15,000 per person? The answer is no, but if you give more than 15,000 per person, you're supposed to make a gift tax filing in which you report that. So if you want to, most people want to avoid making that filing, but if you gave, 100,000 to your son, you wouldn't be taxed on it because it'd be within the exemption amount, but you would have to file a gift tax form.
Well, Bob, can I just add, you can choose, actually, you can pay the gift tax now, or you can wait and use up your gift and estate total exclusion. So that you can pay gift tax with the return. And if you don't want to pay that gift tax, you have to use part of your lifetime exclusion amount, which is the 11.58 million right now, just to be clear on that. Yeah.
You're absolutely right, Michelle, though most people would choose not to pay the gift tax now and use part of their exemption if they could. But you're right, they could choose to do that.
Yeah. Okay. One question that's interesting that's been getting a lot of press lately, there's a question here that says, I've been paying for my daughter's education without using a loan. Will I get any forgiveness? And this, also brings up the question about what is President-elect Biden's plans with respect to student loan debt?
Yeah, well, that's an interesting area about whether there's going to be forgiveness of student loan debt. And if correct me if I'm wrong, Michelle, if he does it administratively, then usually forgiveness of debt creates income for somebody. But legislatively, if they do it, they might be able to say, we're not going to create any, this won't be taxable income. But if they do it administratively for federal loans, which is possible, don't you think there'd be income that's created by that, Michelle?
Technically, yes, in general, that's true. Debt forgiveness is income to you, but I would predict they would say it's non-taxable.
Okay, well, they can definitely do it with legislation.
Yeah,
If
yeah,
they do it administratively, I'm not sure there's going to be a lot of people challenging that one.
yeah, that's right. I agree. I agree. Okay, great. So these are great questions. So Bob, how about we move along to the business tax section and then we'll have open Q&A after that.
Okay, so let's start with payroll taxes. So this is something that President Trump has pushed very hard, but the world has not been that receptive to it because these are just deferrals. Employers now and employees both contribute 6.2% of wages up to about, was it 137 now, 135, something like that.
137.7, I think.
37. And Congress allowed employers to defer their portion during 2020, but they had to pay half of it at the end of 2020 and the other half the end of 2021. So most employers did not take this up. The administrative hassle was significant and they had to pay it back, but there are some that took advantage of it, and it's perfectly legitimate. Then President Trump, by administrative order, gave employees the option of deferring their 6.2% to 2021. So very few employees exercised this option because they had to pay it back the next year. But President Trump mandated this deferral for all federal employees, including armed services. So around Washington, D.C., there are a lot of people who have their 6.2% of payroll tax deferred. There's also this employee retention credit, and that was in the CARES Act, refundable tax credit against the employer portion of Social Security taxes, but it was quite stingy, only $5,000 per employee, and it applied only if a business had gross receipts that went down by over 50%. So let me just talk about these things, about what might change in these, Michelle, and then take the other business taxes separately. So I think for President Biden, the big question will be, what about all these federal employees where there was a mandatory deferral of their payroll taxes to 2021? He might try to find a way for them to defer it further or not to pay it back at all, but then he'd have to find some way to help the Social Security Trust Fund. On the other hand, Michelle, if he gets a majority in the Senate, I think, as we said, he's very likely to try to apply the payroll tax above 400,000 and not stop at 137. On the employee retention tax credit, we look at the CARES Act and all the different versions that are floating around. That's actually one point in which Democrats and Republicans seem to have some consensus that they want a more generous employee retention credit. I think we would have a more generous one. I don't know, Michelle, were there any questions in the chat about these?
There's still a lot from the other sections, which we'll try to come back to.
Okay, well, let's go on to the other business taxes, and then we'll give you a chance to look at these.
Yeah.
So there are a set of fairly technical changes here that essentially where the CARES Act in 2020 reverses what was done in 2017. 2017, as you may remember, the corporate tax rate was brought down from 35 to 31 to 21%. And as part of that, to keep the cost of that bill down, there were various limitations that were built in. And they were basically waived for 2020 here. So this is a good example. The 2017 Tax Act, it limited interest deductions of businesses of size to no more than 30% of adjusted taxable income. This was raised to 50% in the CARES Act and applied not only to 2020, but to 2019. And similarly, the 2017 Tax Act, it prohibited individuals from using more than 250,000 per person or 500,000 for joint filers to offset non-business income such as wages and investment. And this limit was totally repealed in 2020. So you could essentially take whatever losses that you had, not only for 2020, but for 2018, 2019, and offset use those business losses to offset non-business income. Let's go to the next slide before we do Q&A. So this E here is probably the most significant, is NOLs are net operating losses. And in the 2017 Tax Act, it said that NOLs generated in 2018 and the future can no longer be carried back to offset income in prior years, but can only be carried forward to offset 80% of taxable income. Under the CARES Act, net operating losses for 2018, 2019, and 2020 may be carried back for 5 years to offset taxable income. So this is a very generous provision. Some people would argue overly generous. It applies not just to NOLs from 2020, but NOLs from 2018 to 2019. And it can be used to offset corporate income in 2017 and earlier when that was being taxed at 35% rate. So that's a real favorable provision for companies. Lastly, bonus expensing. In 2017, the Tax Act allowed 100% expensing. If you made an investment in depreciable property, you got to take the whole deduction now rather than spreading it out over the depreciable life of the property. And the CARES Act did two things. One, it corrected an error in the 2017 Act so that this 100% expensing applies to improvements in depreciable property as well as new investments. Also, it allows these expense deductions to be carried back. So what you can do is if you have big enough expense deductions, 2020, that may create an NOL, and then you can carry that back 5 years, so even to times when you were paying taxes at a 35% rate. I know some of these provisions are fairly technical, but you'll have the slides and you can rely on them if it's hard for you to follow all the ins and outs. So we ready for questions, Michelle?
Yeah, I think there's quite a few here. Not so many on the business provisions yet, but those will likely come in. But did you want to also remark any more about?
Yeah, sure. We ought to talk a little about Biden and the business provisions.
Right.
So following your general methodology, if the Democrats don't get the Senate, there's a limited amount he can do on this because these are legislative provisions. Michelle and I have spent a little time on the foreign tax provisions. That's the foreign income of US-based companies, multinationals. There were very complicated provisions in the 2017 Act, and there were regulations that were promulgated for those. And some people would argue that they're a little too favorable for multinational corporations, and so he could try to take back those regs. And then there's another set of provisions on that relates mainly to partnerships and small businesses, where except for what are viewed as knowledge-based partnerships and businesses, you could reduce your taxable income by 20%. And the Treasury came out with regs on those, which were, again, they were pretty tough on accountants and lawyers, but on other knowledge-based professions, they were pretty flexible. So he could try to go back on those. If we think about the question of what happens if the Democrats get the Senate and retain the House, then Biden has a pretty broad program of tax reform. He would want to bring the corporate tax rate back up to 28%. And that's probably the most important thing that he would want to do. And looking at foreign tax, he'd probably want to have a minimum tax that really applied a lot more strictly, so that you wouldn't have the situation where you had big multinationals who wound up paying close to zero or at zero US tax. So I think those would be the biggest. A lot of other things they might do, especially trying to change the use of net operating losses going to times when companies had a 35% tax rate. So let me stop there and take more questions.
Okay, great. Thank you. So there's still not too many about the business tax, but we can
Okay.
kind of go back to some of the, so one that's getting quite a few upvotes is that say they're going back to say the stimulus checks. And the question is basically, if you didn't get one in 2019, either based on your 2019 income or it just never came, can you still get it after you file your 2020 return?
The answer is yes. You ought to go and, depends on what your income level was, but if your income level in 2020 is less than 150,000 for a couple, then you can file your return and claim that, but technically, I believe, an advanced tax credit.
Yes.
So you can do it. You probably want to consult the tax accountant about exactly how to do it, but it's definitely doable.
Yes, I agree. The next question that's also getting quite a lot of upvotes is there any chance of no required minimum distributions in 2021 for IRAs?
I think that there's always a chance, but I don't see it in the versions of the CARES Act that are floating around now. I guess if 2021, the recovery with the vaccination doesn't happen very quickly, and we have another recessionary period, we might have that, but I wouldn't count on it. I would say it's a low probability event. I don't know, Michelle, what's your view?
Yeah, I agree. I think, some people were quite puzzled when that part of the CARES Act was put in place. And I think in general, it was because the market dropped so far that they didn't want to require people to take distributions out when the market had crashed so much. But since the market came back quite a lot now, I'm with Bob. I think it's unlikely we'll see another one in 2021. But you never know. Yeah. And then the next question that is also getting some upvotes is that 10% penalty waiver on the early withdrawals from retirement accounts. Is there a limit on the amount you can withdraw and not have the 10% penalty apply.
I don't think there's, I mean, you had to withdraw it by a certain date, which is now, let me look at that again. I don't think there is a limit in terms of what you can, how much you can withdraw as a matter of in that tax provision. So,
Yeah, Bob, actually, I think it might have been limited to the 100,000 there.
well, that's the loan, right?
This also says temporarily waives the existing 10% penalty from early withdrawals from qualified retirement plans up to 100,000.
Yeah.
So I think that was the law in the CARES Act when that came out.
Okay, thank you.
Yeah, I know it's hard to remember all these details.
Yeah, $100,000. Thank you.
Yeah. Okay. One other question that's quite interesting, I think, that came up is we've talked a lot about the federal level issues. What do you think the states might do given their fiscal issues and problems that they're having?
Yeah, I don't think we're likely to see a lot of states lowering their tax rates, but states are, they may wind up getting, I think people are in the latest version of the second CARES Act, they're talking about something in the $160 billion range. So, there are some states that follow the federal law pretty closely. Massachusetts is not one of them. So, for instance, on the withdrawal, of income on various retirement provisions, if you're in a state that follows closely, then maybe the states will wind up doing what the federal government did. But I think in Massachusetts, the legislature has never really felt that they were copying the federal law. They would decide what to do themselves. And, I guess you could theorize that the legislature might allow people to pay lower rates or to be able to, have certain leniency, but I don't know. I guess I would say, Michelle, my general judgment would be no. States are in such trouble now that I don't think they have a lot of ability to grant a lot of flexibility on the tax side. But maybe, Michelle, you had some different ideas on that.
No, I would agree with you. I would agree. I think the other side too is, whether they'll have to increase rates or change, go the other way if they're in such fiscal, they have so much problems. And I think they might be waiting to see what the federal government does for them in some cases.
Yeah, I think that's a very relevant point because states that depend heavily on property taxes or cities on property taxes, if those properties go way down in value, so then they're going to have to figure out some other way to raise revenues. So I guess I interpreted your question about whether they were going to have
Both ways.
lower taxes, but you're right. The more likely scenario is on the higher side.
Yeah. Okay, these are great questions here. Several of these questions, they're phrased in different ways, so they're not necessarily getting upvoted, but some are about also the estate and gift tax of if they do a certain thing now, if they gift an amount now, what happens to their exemption then upon death if the exemption becomes lower in the future? And if they do certain things now under the current law and the law changes, how does that affect their limits and things going forward?
Yeah, well, I think, and there's a technical answer and a reality answer. The reality answer, which I think is going to hold, is if, for instance, you give away, I'm just coming up with a number, $12 million this year, and then the exemption limit is reduced next year from 12 million to 10 million, I don't think you're going to get taxed on it. I think it's not going to be retroactive. Now, technically, it could be, but I think whatever you get in now under your exemptions is going to hold. And I don't see I don't see a lot of appetite for retroactivity. That's what we're really talking about. What would you say, Michelle?
Yeah, I would agree with you. I would agree. And some of these get quite difficult. And in fact, oftentimes when we have big law changes like this, they will have to issue guidance to say how they will treat future transactions. So a good example is right now, the limit, as Bob discussed, for the estate tax is very high, this 11.58 million per person. And the question is, if spouse number one passes away and court gives their remaining exemption to the spouse number two, and then the tax law changes, what happens to that unused exemption amount that was given to spouse number two? Is it still the 11.58 or does it go down to the new rules? And there was a lot of confusion about this, and the IRS had to issue some guidance about this. So I think sometimes we just don't know what the answer is, and the government can kind of decide as they go along, which makes planning very difficult, of course. So we would like more guidance, but we don't always get it until the law changes. But I think Bob's right. It's unlikely it'll be retroactive.
Yeah, I think it could be, but I generally don't think that would happen.
Yeah, I agree.
But I think let's be clear. If there is a law that passes, say, on April 22nd, and you do something in that same year in March, then I'm not sure you're going to be okay, because usually when those laws get proposed, people think that then you're on notice that those laws are could change, and so within the same year, you shouldn't get a lot of comfort. Didn't you agree on that, Michelle?
Yeah, I agree. Another question that's here that I think is interesting, and you touched on it a little bit, Bob, is about the state and local tax deduction for the itemized deductions.
Right.
Say President Biden would lift that amount up so that it's not limited at 10,000, but it's limited at something else. Or what he might do, how would that affect the rest of the itemized deductions? Does Biden have plans to change that, or would it affect people's charitable contributions, things like this?
Well, those are good questions. And I think there are two different approaches. One is to keep the limits per specific deduction, or to have a more general thing. I think by lifting the 10,000, if you lifted it to 20 or 30,000, I think the distribution would be heavily skewed toward higher income people. So first of all, we have relatively few people now who are itemizing at all. We're down to, isn't that, Michelle, about 15, 16%?
That's very low.
Who itemize. And so they're the only ones to take advantage of this. And then lots of people live within the 10,000. So there would be an effort, especially for a place like Massachusetts, New York, and California, to raise that 10,000 to 20 or 30,000, but there could be pushback on the distributional aspects of it. A second approach that we see, that Biden has talked about, is to establish some limit based on your adjusted gross income. So you could say, everyone would have the ability to deduct, let's say, up to 20% of their adjusted gross income for all deductions. And that would not just apply to state and local, but apply to gift, et cetera. Politically, that might actually be easier than trying to change the gift tax exemption deduction, or change the local and state. So that's another way to go. I don't know, Michelle, do you have a sense of what would happen on this? There's so many different design issues that could be taken up.
Yeah, with the itemized deductions, it might be quite limited. I think what is in Biden's plans now is essentially that he would limit itemized deductions essentially to a 28% rate, kind of in the spirit of what Bob was just saying. And then he would also, what is in his plan anyways, to put what's called the PEAS limitation back in, which is a limitation named after a congressman from a long time ago. But he would limit itemized deductions on top of that. So while he might lift the state and local deduction, which would appease the blue states, he might just put an overall cap back in. So you may or may not be better or worse off. It's hard to say, but he's going to give and take away at the same time, most likely.
Yeah, I think that sounds to me about right. That he probably will raise the 10,000 for state and local, but there will be an overall cap for deductions based on some percentage of your adjusted gross income. And actually, I think that's sort of the right answer, to look at all deductions together. Don't you, Michelle?
Well, Bob, you're at a different stage of life. You don't have a home mortgage and kids and stuff like probably the rest of us. But yeah, I mean, there was a question here about whether the home mortgage interest limit would be lifted again.
Oh, I think there was so much blood on the table getting that to 750,000. I don't think there's a lot of appetite to revisit that one. Do you?
No, not at all.
I agree.
Yeah, these are great questions people are sending in. There's a couple questions about mark to market. And some of those questions are, would mark to market apply within a 401k? And then the other one is, what about losses when you do mark to market?
Well, those are very good questions, and just shows how complex such a proposal would be. I think what people are not talking about marking to market within a 401k at the moment, but I don't, people haven't really focused on that aspect of it. I think there's a second question is, will you do this just at the end of the year, or will it be based on your average price throughout the whole year? And then thirdly, people saying, what happens to losses? So, in some of these proposals, the losses are sort of banked for the next year, and sort of there's a rolling computation. So if you have a loss this year, and then say a loss of 20 this year, and next year you have an unrealized gain of 30, and maybe you can use the loss against the 30. But these are the sorts of administrative questions that really would make this a nightmare. And I'm not sure it will pass just because of the difficulty of doing this. Remember also the question of how do you deal with assets that aren't like stocks and bonds and don't have a readily ascertainable value. So are you going to require an appraisal every year, or are you going to wait till those assets are sold and then increase the tax by some sort of interest accrual for what would have happened over all those years? These are the sorts of strategies that people are talking about. But I know, Michelle, you would agree that this is like the tax accountant's dream, but a nightmare for everybody else, wouldn't you say?
I think it's our nightmare too, actually, Bob. It would be extremely complicated. I mean, they've looked at this over the years many times, and it usually fails just because it's so administratively complicated and so many situations that there's really no good answer to. Small businesses, very hard to apply this, because if you get an appraisal and the value increases, are you going to make the small business really sell part of the small business? It doesn't make any sense, and so they need to carve out all these exceptions, and then it gets really complicated. So I don't know, it might happen, and maybe it would happen on just only marketable securities, something like that.
Yeah, of course, if you did that, then that's a real incentive for people to move out of marketable securities. And I don't know whether that's a good thing for the economy.
Yeah, I agree. I think in some people's minds, maybe they're after, say the Jeff Bezos, the Mark Zuckerberg kind of people, where they get all this wealth, then they can run it through their estate, never pay tax on a lot of these gains. I think that's kind of what sometimes they have in mind, but it's hard to apply to the rest of us. Yeah. Do you think, Bob, would you agree with that?
Yeah, I agree. It's definitely an area where people should move slowly, if at all. It's complicated. So I mean, the one thing is Wyden he's now the ranking member in the Senate Finance Committee. Is that true?
I think that's right. Yeah.
So he would become chairman of the Finance Committee in the Senate side, and this is his pet project. So that might mean, that it would have more legs than you or I would think on administrative. And I know his staff thinks they've solved a lot of the administrative problems, but I'm not sure they have.
Right, right, I agree. There's a question here about donor advised funds. Bob, I know you have some opinions about these. One is, will gifts to a donor advised fund lower the assets subject to the lifetime exemption?
Well, I think a gift to the donor advised one is like a gift to public charity. So it doesn't really affect the lifetime exemption. Any gift to charity, your lifetime exemption is for gifts to other people, usually other family members. Any gift to charity does not lower your lifetime exemption. And a donor advised fund is considered a charity for this purpose. So any gifts that you make to a donor advised fund, then are they're like a gift to MIT. They're a gift to a charity, and so they don't impact your lifetime exemption at all. So people are often confused on that, but the lifetime exemption is only for gifts to individuals, family members. Any gifts to any charity don't impact your lifetime exemption, and a donor advised fund is considered a charity.
Okay, great. We have another question that's kind of about a state gift, which I think we can infer maybe means our alumni are doing very well. Yeah, that's great. That's great. What are the tax consequences of transferring appreciated assets to a child?
Well, it's considered a gift, and you have to usually get a valuation of it, and your child takes what's called the child takes the basis that you have in the assets. So to take a simple example, if you bought a stock for 60 and it's now 100, you give it to your child, you will be using up 100 of your lifetime exemption, assuming you're over the 15,000, and your son or daughter will have the $60 basis. So if they go and sell it for 100, they're going to have to pay $40 of capital gains. So that's the opposite of step up in basis. Step up in basis is only at death, and therefore, if you think step up in basis is going to continue for a long time, you would usually not give highly appreciated assets to your children until death, because at that point it steps up. If you give it to them now, then they're getting your basis, which is much lower. On the other hand, if you think step up in basis, death is going to go away, well then that's a whole different story.
Yeah, okay, very good. There's one here, and it asks, have there been any changes in 2020 that would impact U.S. citizens residing abroad?
That's a subject I'm not an expert on, and I'm not sure whether there have been any changes on that. I don't know, Michelle, do you have?
Yeah, I don't work in that area either, so I don't know exactly.
I don't remember anything in the CARES Act that impacted that.
I don't recall it.
Yeah, but I don't want to give somebody bad advice here, so you ought to take a look yourself.
Yeah.
Or better yet, ask the tax accountant. I don't think there were changes, but I might be wrong.
Yeah. Okay, I think it's about time to wrap up, but I think, Bob, you said you'd be willing to stay after, so I thought I'd kind of give the ending thank yous, and then if people want to stick around until 1:15, is that right, Bob? You said you could stay if
Yeah,
people have
sure.
more questions.
Right.
Okay. So I guess thanks to Bob, for being here today, and on behalf of the Alumni Association, thanks to all of you for participating in this broadcast. We'll be sure to forward all the questions submitted to Bob so he can spend the next few weeks trying to answer these.
I don't want to promise that one.
Yeah, they're great questions.
I think we can run some of these questions now. Once we finish, we should be able to do that.
Yes. And this broadcast will be available on the MIT Alumni Association YouTube channel within a week of today's airing. And so thank you all again for attending. And if you want to stay around and ask some more questions or listen to the remaining questions, try to get answered, you're welcome to do that.
Thanks for joining us. And for more information on how to connect with the MIT Alumni Association, please visit our website.